Good morning. Welcome to the Heritage Foundation and our Lehrman Auditorium. We, of course, welcome those who join us on all of these occasions on our heritage.org website. Would ask those here joining us in person if you'll check that cell phones have been turned off as we prepare to begin. It is always appreciated. We will, of course, post the program on the Heritage homepage for everyone's future reference following today's event. Opening our discussion and hosting today's program is David Burton, Senior Fellow for Economic Policy in our Institute for Economic Freedom and Opportunity. He focuses on tax matters, security law, entitlements, and regulatory and administrative law issues. Prior to joining us, he served as General Counsel at the National Small Business Association. He's also been Chief Financial Officer and General Counsel of the Alliance for Retirement Prosperity, and was a partner in the Argus Group, a public policy and government relations firm. Please join me in welcoming David Burton. David?
Good morning. Our subject this morning is taxes and entrepreneurship. Entrepreneurship matters. It fosters discovery and innovation. Entrepreneurs also engage in the creative destruction of existing technologies, economic institutions, and business production or management techniques by replacing them with new and better ones. Entrepreneurs bear a high degree of uncertainty and are the source of much of the dynamism in the economy. They innovate, providing consumers with new and better products. By providing other businesses with innovative, lower-cost production methods, entrepreneurship is one of the key factors in productivity improvement and therefore in real income growth and higher real wages. Entrepreneurs are central to the dynamism, creativity, and flexibility that enables market economies to consistently grow, adapt successfully to changing circumstances, and create sustained prosperity. The economics literature demonstrates that new and startup businesses account for most of the net job creation in the United States economy. But entrepreneurship is in decline. Business exits now exceed new business formations. The share of firms aged 16 years or more has increased by 50% over the past 2 decades. High-tech companies are shedding more jobs than they're creating. And the Wall Street Journal reported earlier this month that the share of entrepreneurs among those under age 30 has steadily dropped by 2/3 over the past quarter century. Although recovering with the substantial recovery in equity market values over the past several years and the regulatory improvements in the 2012 Jobs Act IPO on-ramp, initial public offerings remain substantially below the level of the previous 2 decades. There's been some improvement since the depths of the recession, but small and startup businesses continue to struggle. There are many reasons for this decline, but along with inadequate access to capital and the overall regulatory burden, poor tax policy is one of the most important reasons. High marginal tax rates and a poor treatment of risk investment capital matter a great deal. But the disproportionate burden on small firms of the compliance cost imposed by our monstrously complex tax system is probably the most important. There's a reason to hope that the Congress will address these problems in the coming years. Today, we have 3 excellent speakers, although one hasn't arrived yet, who will explore how the current tax system affects small businesses and entrepreneurship. Karen Kerrigan will lead off, followed by Diana Furchtgott-Roth, and then Curtis DeBay. And then we'll proceed to audience questions. Now allow me to introduce our speakers. And excuse me, I've been fighting off a cold. Karen Kerrigan is President and CEO of the Small Business and Entrepreneurship Council. She regularly testifies before the United States Congress on key issues impacting entrepreneurs and the economy. She's been appointed to numerous federal advisory boards, including the National Women's Business Council, the U.S.-Iraq Business Dialogue, the U.S. Treasury's Taxpayer Advisory Panel, and the National Advisory Committee for Labor Provisions of U.S. Free Trade Agreements. She's a founding member of the World Entrepreneurship Forum, and she's a board member and former chair of the Center for International Private Enterprise, CIPE, one of the core institutions of the National Endowment for Democracy. Inc. magazine named her to its Small Business Best Friends in D.C., and she was named a top 100 champion small business influencer by Small Business Trends. She graduated from SUNY Cortland with a BA in political science. Diana Furchtgott-Roth, former chief economist of the U.S. Department of Labor, is director of Economics 21 and a senior fellow at the Manhattan Institute for Policy Research. Excuse me. She has served in the White House as the chief of staff of the Council of Economic Advisors under President George W. Bush, as deputy executive secretary of the Domestic Policy Council under President George H.W. Bush, and as an economist on President Reagan's Council of Economic Advisors. She's the author or co-author of 5 books, most recently Regulating to Disaster, How Green Job Policies Are Damaging America's Economy, and Women's Figures, an illustrated guide to the economic progress of women in America. She's a contributing editor of Real Clear Markets and a columnist for tax notes and MarketWatch.com. She regularly testifies before Congress. She received her BA in economics from Swarthmore and her MPhil in economics from Oxford. Curtis DeBay, who is now with us, is a research fellow in tax and economic policy here at the Heritage Foundation. He's authored numerous reports on tax policy, testified often before Congress, and made numerous media appearances. Before coming to Heritage, he was a senior associate at PricewaterhouseCoopers, where he structured international transactions as part of the accounting firm's transfer pricing group. He previously served as senior economist at the Tax Foundation, where he authored 3 widely recognized and cited reports: Tax Freedom Day, State and Local Tax Burdens, and the State Business Tax Climate Index. He received his master's degree in economics from the University of Connecticut and has a bachelor's degree in economics and leadership studies from the University of Richmond. Excuse me. Please join me in welcoming Karen Kerrigan.
Well, thank you, David. It's a pleasure to be here today. Thank you for asking me and the Small Business and Entrepreneurship Council to be a part of this panel today. And thank you for your leadership on a host of issues, tax issues, security issues. I mean, we worked with you over the years, many, many years, in the trenches.
Too many years.
Yes, on all these issues. But we're getting somewhere. We are getting somewhere. And certainly from the Heritage Foundation perspective, it's an honor always to be at Heritage. We've looked to the reports, the studies, the analysis of the Heritage Foundation over the past 20 years in our efforts to promote entrepreneurship and to protect small business. And certainly the issue here today that we're discussing, taxes and entrepreneurship, is a critical one. And as you noted in your remarks, entrepreneurship is in decline. There's been it's been a long-term trend. There's been some improvement, but really there's been stagnation. And from our perspective, I mean, this issue does not get the type of recognition that it should on the Hill and in the Congress. And when we talk about tax reform and business tax reform, we're hoping that this panel and your efforts and our efforts will get the Congress and the White House thinking about entrepreneurship when they start fashioning some type of tax reform package. The Federal Reserve put out a report mid last year, which also noted this decline in entrepreneurship. In fact, they found almost a 50% drop in new business formation. In 1978, there were 12 new businesses that were created for each existing business, and that dropped to 6.2 new businesses being created for each new business in 2011. So this has been a trend, and it obviously is one that should concern our country, given that, as you said, entrepreneurship really is the font of job creation, of innovation, and the competitiveness of our economy. Now, the Obama administration and President Obama, the reaction to this, to the whole, to the financial crisis followed by the recession, and then this job situation. I mean, they did, focus somewhat on this whole issue of entrepreneurship. As you recall, there was a whole big Startup America initiative that was launched in early 2011. There was a range of things that they were promoting, education, but and mentorship and all those other things. But part of a piece of that also was, really was a platform for collecting different policy ideas that would encourage entrepreneurship. And out of that, as you mentioned in your remarks, the Jobs Act, along with some advocacy and other things that were happening on the Hill, that package came together that put together equity and debt-based crowdfunding. Although we're still waiting for that to be enacted, and it's just crazy that the Securities and Exchange Commission hasn't really fully implemented Title III and other components of the Jobs Act, as well as I think one of the big tax pieces supported by the administration was a 0% capital gains, the exemption on capital gains taxes for qualified business, a temporary tax measure that only certain businesses would, if you invested in only certain businesses, C corporations, manufacturing, just certain businesses that you'd be able to get this, this type of incentive. That, along with some of the other things that were, enacted by the Congress, you had the extension, of the various Section 179 and bonus depreciation and some other things, But when you really look at it, I mean that. In terms of how those were enacted, I mean, really that just continued to add to the type of uncertainty and the complexity, of the tax system. And while, it helped, some businesses, it really just, I think, continued. So this continuation of uncertainty and complexity that really are the heart of, what drives small business owners and entrepreneurs crazy about our nation's tax system. So, those things were enacted. I mean, where are we now? As you said, entrepreneurship has improved, but, it's still lagging. If you looked at the, Ray Keating, our chief economist, looked at the June 2014 jobs numbers and found that the self-employment numbers were very low. They matched, where self-employment in this country was in 1986. So, and obviously self-employment, and is a sign of entrepreneurial activity. I might add, and again, what you said about entrepreneurship among younger people in this country, the self-employment level among youth in this country, has dropped 23%, which is very concerning. The good news is that self-employment seems to be increasing, or it is increasing among those people that are 65 plus, which is great. I guess I have another career, right? When no, I think that's good news. It's increased by 66%, but and the other piece of good news is that the Global Entrepreneurship Monitor done by the Babson College found that when they looked at 25 countries, that the U.S. still has the most entrepreneurial people. So, while we have the most entrepreneurial people, we don't necessarily have the most entrepreneurial type policies. We all know about the corporate tax rate and how uncompetitive that is, but there's also been some global studies that show just how uncompetitive and how far we've dropped in terms of how the competitiveness of our policies. For example, the World Bank, the latest World Bank Doing Business report in 2015 found that the U.S. ranked 46th in terms of ease of starting a business, and 47th in terms of the measurement with respect to taxes. So, for a country that is known for its entrepreneurship, for a country that really entrepreneurship and encouraging entrepreneurship, teaching entrepreneurship is a major part of our diplomatic and global strategic, policies in terms of helping other countries embed entrepreneurial principles that will hopefully, and free market principles that will hopefully lead to democracies in those countries. We're really not doing a good job at home. We're not walking the talk. I was at the Global Entrepreneurship Summit in Morocco just this past November, and I got to tell you, Vice President Biden gave this incredible speech. I was like, yes, and low taxes, regulatory relief, private property rights, strengthen IP, this and that. And I'm like, wow, that is fantastic. I wish you would give that same type of speech at home. So we need to walk the talk here in the United States if we're going to have more entrepreneurship in this country. Let me just really quickly, we have 100,000 members throughout the country. We network with a lot of state and local business groups. We talk to entrepreneurs and small business owners every day. You know, those at every stage, the startups to those who have been around 20, 25 years. So, you know, we know exactly what bothers them about the tax code, and not much has changed in terms of what bothers them. It's the degree to how much this is really impacting their businesses. The complexity, I mean, in the last 8 to 10 years, just the uncertainty, the never-ending changes that continually happen, how the tax code is in flux, and of course the burden, both the tax burden and the compliance burden. The last National Taxpayer Advocate report that came out showed that small businesses spend about 2.5 billion hours on compliance with the tax code, which amounts to just over, I think, 1.25 million employees. That's the equivalent of. Now they peg it that business owners and entrepreneurs spend about 13 billion on compliance. I think that's a very very conservative number. And so complexity, you know, cost. Look at this is time, money, and energy that's taken away from what they should be putting into their businesses, to building durable, sustainable businesses, to competing in the global market base. This is real money, real time, you know, and expertise that's being taken away from their firms and going into complying with this monster that we call the U.S. tax code. You know, you know, if you just look at this last round of extenders that were quote unquote extended, really just made retroactive. I mean, just gives you a sense of what, when we talk to our members, what they had to deal with. Throughout the course of the year, I mean, we heard from our members. We had the very liberal expensing amount that basically was lowered to $25,000. You know, we get calls saying, well, gee, we heard they were going to possibly extend this, and I'm going to make this $600,000, you know, purchase, you know what I mean, because I got this big order coming in. Should I do it? I'm like, oh, God. We don't give tax advice. I mean, but this is, I mean, these are the real issues that entrepreneurs are, you know, have had to deal with. You know, other entrepreneurs who maybe have several businesses, and they're looking at, I remember in the summertime talking to another entrepreneur who is rehabilitating and restoring a downtown to make it really a vibrant place for the community and for businesses to move in there, who basically put off all of his capital investments because of this Section 179. And, you know, finally, you know, the thing got, you know, extended, but really retroactive to the past year. So we're really limiting. So it stings from a business planning perspective because you can't plan. You know, if you're someone savvy and you've been around a long time, maybe you can hedge and say, well, the Congress will pass this. But for the most part, we're really limiting the benefits of these tax provisions by the way that what we've done in terms of just extending and, you know, the politicking around this and it not being permanent. But that's just one example, again, of the complexity, the uncertainty. You know, you have so many other, I mean, just the sheer, you know, the taxes that business owners, you know, have to pay. And, you know, from our perspective, and how long have I been going now, David? Sometime I tend to...
Probably about 12, 13 so far.
Okay, well, let me just, I'll just quickly wrap it up and turn it over to Diana, and then we can have some Q&A. But, you know, we think there's a terrific opportunity, you know, for tax reform. And it would really be a shame, you know, if there were, you know, if partisanship and jockeying, you know, ruined this opportunity. You know, I spent some time at the Hill. I spent some time at the White House. I've spent some time this week over at the Treasury Secretary. And there always seems to be common ground on this issue. I guess it's the little details that blow things up. But, you know, when we talk about business tax reform, you know, what we'd like to see is equitable rates, you know, lowering those corporate and individual rates. I mean, you know, small businesses, you know, 96% of them are pass-through entities and, you know, pay taxes at the individual rate level. We certainly, you know, want to see corporate tax reform too. We have a subset of our organization members who are corporations, and lowering that rate would be great for them. It'd be great for the suppliers, you know, who work with small, who who work with these large corporations, and it would be great from a competitiveness standpoint. On the expensing end, I mean, just making that permanent would just be an extraordinary from a certainty perspective, from a business planning perspective, cost of capital, cash flow perspective, and from basically reducing complexity as well. And on the flip side, I know I talked about Startup America, and what the big focus was on sort of those initiatives was access to capital. But if we are going to have robust capital formation in this country, you know, we really do need to reduce or eliminate the capital gains tax. And I think the president, in his 0% exemption for certain qualified businesses, saw the benefit of doing so. But why can't that be, you know, just wider to include all businesses and all investments? And there's just a range of other things. I think, you know, just modernizing one thing. I talked to a lot of our accountants who work with micro businesses and experts who work with teens who are doing micro businesses, and they're either turned off or turned on by the process. And I got to tell you, the tax thing is what turns them totally off. When you reach that $400 threshold of income that you're getting, you know, you have to start paying that self-employment tax. Now, that hasn't been modernized for about decades. I think it's 30 plus some odd years. Even if that kept pace with inflation, that would be, before you start having to pay that self-employment tax, it would be close to $6,000. Well, what a great thing that would do, not only to encourage young entrepreneurs to start businesses, but, you know, all the other people who are looking, who are now either home-based businesses or doing, you know, some type of business operation on the side. How great it would be to be encouraging just on that one small provision alone. So with that, let me just say this is you know, it really is a great opportunity. I really hope that we do have some type of tax reform this year. We do need to increase entrepreneurship in this country, and the whole tax piece is just such a critical component of that. So thank you.
Thanks very much. And David, thank you very much for inviting me to join this panel. And I want to thank Heritage for putting on an event on this so important subject. It's an extremely important subject. A few years ago, I edited this volume called Overcoming Barriers to Entrepreneurship in the United States. And of course, there was a chapter on tax policy. The chapter was written by Donald Bruce of the University of Tennessee and Tammy Gurley-Calvez of the University of Kansas. And the question is, should we have favorable treatment for small business? Should there be carve-outs in favor of small business? And the authors concluded, no, that we should have a uniformly simple tax code that would apply to everybody without any specific carve-outs. Now, most businesses are non-farm, small proprietorships, partnerships, subchapter S. They all fall under the individual tax code. And that's why it's important when we're talking about tax reform to combine individual tax reform with corporate tax reform. It's not just those two individual tax codes that we have to be concerned about. Entrepreneurs also have to pay unemployment insurance, workers' compensation, the estate tax, and for the past, and since January the 1st, companies have to worry about the tax for the Affordable Care Act. And these are all things that different entrepreneurs have to be concerned about. So I'd like to talk about, first of all, the individual tax code, which we need to make. We need to broaden the base, have lower rates, and make it fairer and simpler and easier to comply with. It just takes an awful lot of time, as all of you know, to be filling out these forms and worrying about these issues. When it comes to the tax on for the Affordable Care Act, it's noteworthy that President Obama postponed this for 2 years for small business. So just for those who don't know about it, if you're a small business and you employ 50 or more people, you have to pay a tax of $2,000 per worker if you don't offer the right kind of health insurance. That was supposed to kick in on January 1st, 2014. Well, President Obama obviously knew how destructive that tax would be, and so he postponed it to January 1st, 2015. Then, in the middle of last year, he postponed it again a year for small businesses with between 50 and 100 employees. That is postponed to January 1st, 2016. Now, if this tax were easy, if it would benefit companies and workers, then he would have just had it go into place on schedule a year ago, but he didn't. What it does is it, first of all, raises the cost of employment, and that gives firms an incentive to substitute part-time workers for full-time workers. It gives them an incentive to substitute machines for human beings. And that's one reason, I think, why employment has not grown as quickly coming out of this recession as it has coming out of other recessions. Because when you have an incentive to just cut your workforce, then that has vast effects on the whole economy. We have been seeing the past couple of years increases in employment, and I think, and also higher GDP growth. And I think that it's interesting that this started to pick up in 2013 and then more rapidly in 2014, even though the bottom of the recession, the beginning of the recovery, was in fact June 2009. So you might ask, why has it taken so long for the recovery to kick in? Well, one reason is, if you recall, in 2009, people were saying the Bush tax cuts are going to expire in 2010. And in 2010, they got extended a couple more years. Then they said, well, they're going to expire in 2012. There was no certainty in the tax code. It was only at the very beginning of January 2013 that a deal was worked out, courtesy, by the way, of Mitch McConnell, who called Biden and said, we got to negotiate on this, we got to get it done. And they put in place a set of taxes that, even though they were higher than under the Bush years, they were not set to go up. There wasn't that level of uncertainty. So businesses finally knew what they were dealing with. And that was only put in place around the beginning of January 2013. It was only then that businesses could breathe a sigh of relief. And I think it's noteworthy that just in the past 6 to 8 months, we've seen increases in job creation above 200,000 a month. Whereas in prior recessions, that took place a lot sooner. Entrepreneurs often grow into big businesses. We can see Facebook, we can see Google, we can see Yahoo, we can see eBay. That's why it's important also to fix the corporate income tax. And our corporate income tax is the highest in the industrialized world. We tax companies plus we tax companies on their worldwide income, not just the income they earn in the United States. Our top tax rate is, when you add state tax rates, it's 39% for corporations. OECD average is 24%. And there's only 6 other OECD countries that tax companies on their worldwide income. Well, I have a suggestion which is going to be published in tax notes on the 26th of January, which is just eliminating the corporate income tax altogether. And it's not just my idea. It was a bipartisan proposal put forward by Alan Viard of the American Enterprise Institute and Eric Toda of the Left of Center Urban Institute Tax Policy Center. We only get 10% of tax revenue from the corporate income tax, but companies are holding about $2 trillion in earnings outside, because if they bring them in, they would be taxed. And you've noticed this flood of inversions, as they're called, where Burger King, for example, is being acquired by Hortons of Canada. It's becoming more advantageous for our American companies to have headquarters offshore than headquarters here in the United States. So there has to be something wrong with that. And if you're a foreign company, say you're Burger King, and you want to bring in $100 million from all your operations outside and invest it in the United States, you have to give $35 million of that to Uncle Sam, to the U.S. Treasury. But if you are Tim Hortons, the donut company in Canada, you want to bring in $100 million to invest in donut stores here in the United States, every penny of that $100 million can be used. So the quickest way, if companies want to increase their investment in the United States, is to have this inversion process. Then they can bring back the money, and then they can invest every penny of it here in the United States. So that's why we need to do something about the corporate tax code. And some people suggest just bringing it to the OECD average, 24%, and taxing companies on their domestic income rather than their worldwide income. I would go further, because if we are at the OECD average, there's still half the countries that have lower tax rates than we do, and it would still benefit our companies to invert to those countries that have lower tax rates. So why don't we make ourselves into a tax haven, go to a zero corporate tax rate, and tax dividends to the full extent, to their full extent. Right now, dividends have an exemption. They're only partially taxed because they've already been taxed at the corporate level. We can make up that revenue by taxing distributed earnings fully as regular income. And we could also raise the capital gains tax rate by a couple of percentage points. And if after a couple of years we are still not bringing enough revenue, we could cut back on some of the amounts for 401ks or 403bs or SEP plans, not IRAs, because those tend to benefit middle-income taxpayers. But we could cut back on some of those other exemption amounts to make up that revenue. But there would be nothing better for the United States than to be a tax haven where people would want to invest here, people would want to invert to the United States rather than wanting to invert to other countries. And now, before I turn it over to Curtis, I just want to mention one other point that is very important to entrepreneurs, which is the estate tax. And in the waning days of the 2014 Congress, Representative Andy Harris of Maryland put out a bill called the American Solutions for Simplifying the Estate Tax Act, called the asset tax. And many small businesses have the problem that when the owner dies and the estate tax is due, they have to break up some of the estate and sell it in order to pay the tax. Now, the tax is 40% on $5.25 million and above. And if you have a large farm, or you might have a big franchise operation that might have assets, it can easily have assets of that amount, not just because land values have gone up and property values, and large businesses can easily fit into that category. So what Andy Harris has proposed is that the estate tax, be postponed until the estate is sold. And people have an option of doing this. They could choose to have pay a higher income tax, 1 or 2 percentage points currently, in return for having the estate tax postponed till the estate is sold. So that means, for example, if Furchtgott-Roth Auto, which has auto dealerships all over this area and also in Florida, if Jack Furchtgott-Roth were to die, which unfortunately one of these days he will die, that means that his heirs would not have to sell some of his dealerships to pay the tax. He could be paying a higher income tax now and postpone the estate tax until his heirs decided to sell Furchtgott-Roth Auto. You see, and this is a revenue-neutral bill. So I think this is something that we need to keep an eye on, to make sure that businesses don't have to shrink when the founder dies. When the Congress is looking at different kinds of tax plans, we hear, and Karen mentioned, equitable rates. And of course, everyone has a different idea of what equitable rates are. For entrepreneurs, of course, an equitable rate is lower. Some left-wing activists think an equitable rate is higher. So I think we need to be making it very clear that there are benefits to Americans as a whole for having lower taxes. It means more businesses locating in the United States. It means more job creation here. And all of us benefit if that happens. And we find that lower capital gains tax rates often have resulted in higher amounts of revenue, higher amounts of realizations. And that's a benefit also. So with that, I'd like to close and turn it over to Curtis.
Thank you. It's a real honor to be up here with Karen and Diana. To kind of wrap up our conversation, they've done a great job setting it up, and I'm going to go through kind of the theoretical, but it really comes down to nuts and bolts, reasons why the tax code and why tax reform is so important to get entrepreneurship going again. And I'm mostly going to talk about the individual side of the tax code, as Diana got hit on the problems of the corporate side. So entrepreneurs are often high earners from big businesses. from big established businesses. So think about it as a executive or a high-level worker at Apple or Facebook or Google who has an idea for the next big app. They're often the ones that strike out on their own to launch a new enterprise. What happens when you raise their taxes like we did back in 2013, or when we keep those rates high? They have less money of their own to pour into the new venture. When they start out, they're putting their own money up to get the business going. So you tax them more, they just have less of a cash reserve to go out and try to start that new business. But also when you raise their rates, you reduce their incentive for taking that risk. It's really risky to be an entrepreneur. Most businesses don't make it. So we want to maximize the incentives for going out and taking that risk. When we have high rates, we depress that incentive. It also makes it harder for entrepreneurs to raise capital when we have higher tax rates. So besides going into their own reserves of cash or personal reserves of cash, they often go to what are referred to as angel investors, friends, family, associates. You raise taxes, you raise high rates, these are also probably likely high earners. You raise tax rates, they're going to have less money to help people get businesses off the ground. But more importantly, when you raise rates, you're raising the hurdle rate on new investment. So when you go to professional investors, venture capital and other types of investment that entrepreneurs need to go to, you're making it less likely that they're going to invest in these new businesses because they just require a higher rate when taxes are higher. It also makes higher taxes also make it harder to keep a new business going once you get it off the ground. So the top rate now kicks in at about $400,000, $450,000 for a married couple. A lot of businesses will be that profitable, and because they're paying on the individual side, the individual rate matters here, when they start out at least. A lot of businesses will make that much in their first years, even starting out. And one of the ways that, besides capital infusions from outside, that a new business will keep going is by using its own cash reserves. Again, when you tax them more, you're taking more of those cash reserves. You're making it harder for them to get through those very difficult, very hard first few years. So the end result is when we have high rates, that we get fewer new businesses, which means fewer new jobs and less wage growth. And what that really ends up happening is we have less chance of the next big thing, less chance that we're going to have a new Apple, a new Google, a new Facebook, a new Twitter, whatever it may be. Really, we want to let 1,000 blossoms bloom, and hopefully we'll get more of the next big thing. A lot of times when I make this argument, I'll hear the counter argument from the left will be, wait a minute, entrepreneurs aren't just starting businesses and looking at what their tax rates will be and all this stuff. They're doing it because they really love it. They have a great idea. They really want to put everything they've got into it. I couldn't agree more. That's absolutely true. It's always important to remember that taxes matter at the margin. All taxes matter at the margin. And when we have higher rates, when we keep rates where they are right now, we are squeezing out the marginal new businesses. And that's really where this comes. Not every business that gets started is that is anticipated to be a big thing. Something that a lot of people doubt often becomes something that is a really great big business that creates lots of new jobs and creates products that are important to our lives. So the more of those that we squeeze out at the margin, the less chance we have, again, of those next big things. So that's why tax reform is important for entrepreneurship. We need to get those rates down. Of course, we need simplicity and less complexity. There's all those things that matter to entrepreneurship. But from the high level, keep rates down. We'll get more new business starts. We'll get more job growth. We'll have a more vibrant and growing economy. Thanks.
All right, thank you all. Before we go to Q&A, I just wanted to add one thing, and it's sort of something that I think a lot of people haven't focused on because it involves an interaction between the securities laws and the tax law. In 2012, the Congress, by large bipartisan majorities, passed the Jobs Act, which was signed into law by President Obama. And among other things, it created a crowdfunding exemption. The idea is that you can use a web funding portal to raise small amounts of money from a large number of investors over the internet. So you might, for example, raise $100,000 by having 100 investors each put in $1,000 via the internet. And that previously would not have been legal. It still isn't legal because the SEC hasn't issued the rules governing the process. But if you think about it, S corporations won't be able to take advantage of that to any meaningful degree, because under subchapter S corporations can only have 100 shareholders. So you'll quickly bump up against the 100 shareholder limit in a crowdfunding world. Similar issues are or raise themselves in connection with Regulation A+, the small issue exemption under the Securities Act, which has been liberalized by the Jobs Act as well, and the SEC also has issued a proposed rule, and that'll become operative when the rule is finalized. So I think there's a need to liberalize the S corporation rules, both the 100 shareholder limit, also allow more than one class of equity, and lastly allow non-resident alien shareholders subject to 30% withholding, as is the case with LLCs and partnerships. With that, any questions from the audience for our panelists? Yes. Oh, if you could wait for the mic so the people on the internet can hear, and state your name and affiliation.
Hi, Carrie Devra, the Center for Copyright Integrity. I actually kept on making notes while you're all speaking.
I hope you wrote down everything we said wrong, so you can ask us
Well, I
about
actually drew pictures too, so I was drawing controls. No, I don't think there's anything wrong, but I don't think it's 100% complete. I come in from the perspective of the arts world. So while we're talking about SEC and crowdfunding, I'm the one that raises the issue about, well, the SEC means that resolution will be done through FINRA, who is the financial industry's regulatory authority, which is very problematic. Simplest description is FINRA keeps crime away from the Treasury and other entities that investigate financial crime. With entrepreneurship, Ms. Kerrigan, I've been looking for the most recent entrepreneurs report. There hasn't been one released in 4 years. There wasn't one released in October. I feel that there needs to be a balance between a weekly jobs report being issued to have an entrepreneurs report. Mm-hmm. Also, what I see in the streets of entrepreneurism is flying in the face of things that Mr. Dubai is saying. We're saying that they're not succeeding as entrepreneurs, but I'll be heading from here up to the Wonder Bread building, which is a WeWork setup where every inch is taken up by entrepreneurs who jump into ideas not understanding that they have a very low chance of success to begin with. Then that also leads into the question about taxes and funding. Well, you've got Tor, Bitcoin, Silk Road. How are you regulating those funds? I was at an ICANN meeting the other day, and ICANN is talking about how they're planning on currently setting up a banking outside of the country. And we all know what that means. It's to not have to own up to the funds here. So from the arts perspective, I see less of an opportunity for my career group to succeed in business with technology. So it's all interwoven into, there's no specific question, but entrepreneurism is not getting the fair description that it should be. And the arts community has been devastated with technology, and I see the SEC as being nothing but a problem stepping into all of this.
Well, it's an excellent question about data on entrepreneurship. BLS every month does publish data on self-employment, and self-employment is not quite the same as entrepreneurship, and some people declare they're self-employed when they're not. But it's actually very difficult collecting good data on entrepreneurs, and the closest we have on a monthly basis is the self-employment data published by the Bureau of Labor Statistics.
Right. Because it gives you an indication of entrepreneurial activity.
Right.
I mean, it's not an exact science, but it gives you some trends.
Right.
You know, the trend lines in terms of where, you know, entrepreneurship is headed.
But all these are just, by the way, self-declared. So you can have someone who is, you know, putting together things in their home and they call themselves an entrepreneur. Or you can have someone who's going to be a Google or a Facebook and they're an entrepreneur to some computer company working out of a garage in Palo Alto that might turn into an Apple. So it's very difficult for us to keep track properly of all these, and some of them grow into large businesses, others stay small businesses, and others, you know, go out of business altogether. It's very difficult for the government to track these from a data point of view, so you're absolutely right.
To address, I think, you know, it's terrific, like incubators and accelerators and places like WeWork, right, collaborative, you know, type of entities are really boomed in this country. I mean, crowdfunding platforms really have turned into knowledge platforms and mentor platforms and, for entrepreneurs beyond just sort of the access to capital piece, which is really great as well. So everything is in place, I think, for robust entrepreneurship in this country. I mean, it really is the policy piece. And in terms of how policy is driving this uncertainty and really is a barrier, to startup activity. And just when you see that those initial taxes, the self-employment taxes or the, employment taxes or your quarterly taxes that you have to pay, and then again, the uncertainty of, am I going to be able to write off $25,000 or is it going to be $500,000 or where, or anything, at all, and what am I going to pay? So, so I don't know. I know you have sort of like a broad statement. That's just sort of, a broad answer. But, the one thing that you had mentioned, though, about the shareholder rule, and it sort of goes back to all policies in general, is what can we do to ensure there's flexibility, I think, in these subchapter, in these rules that, allow, some flexibility to allow businesses to scale, right? If they're going to have more shareholders or if they're going to scale up. And many times, with not only just tax policy in terms of income tax rates and all those other things, but in policies in general, if you grow, you're punished. If you make more, you're punished. And unfortunately, that's sort of the system, that we're sending right now, to businesses. If you grow or make more, it's a bad thing. And this should be a great thing, wealth creation and entrepreneurship. And so...
Another thing that they're punished for is actually laying off workers. So there's the unemployment insurance tax, which is self-funded. But it means if you lay somebody off and then they draw on the unemployment insurance fund, then your unemployment insurance taxes for the next person you hire or your remaining workers are much higher. So all of a sudden your payroll taxes go up. So this basically is another big disadvantage.
Other questions? Salim.
Salim Firth. I'm an economist here at the Heritage Foundation. This is for David or anybody else who wants to chime in on the panel. It's easy, and I'm an economist, so I'm kind of at the edge of the topics that you're talking about, and it's still easy just to get lost in the weeds when you talk about S corporations and subchapter this or that and which exemption. So is there a way from a policy angle to fix enough things at once to make a difference? Because it certainly seems like we could put a lot of energy into getting subchapter XYZ fixed, and that only affects a tiny proportion of the people we're trying to help, and that's not going to make a difference in trend lines.
I think at some level you put your finger on two related and important issues. One is, I've come to the conclusion there is no single magic bullet. The problem really is the combined weight of literally hundreds of rules that need to get fixed. And we need to have a broad initiative that really grapples with the many dozens of important and many more dozens of important but perhaps not as important rules that are a huge drain on entrepreneurship and small business growth in the country. There are some things that matter more than others. The other, I think, problem is a disconnect between the economics community and the business community, or maybe more broadly between the economics profession and the sort of real-world legal problems that businesses face. An example is in Regulation D, which probably nobody knows what Regulation D is. Regulation D is how the vast majority of private capital is raised in this country. It's private placements, $1 trillion a year. But if you ask most economists who deal with entrepreneurship or economic growth issues, they have no idea what Regulation D is. Right? And we just made major changes in the Jobs Act that probably nobody knows this either here. Until a year ago, it was illegal to put an ad in the Wall Street Journal or on the internet saying, I'm seeking rich people to invest in my company because I have this nifty invention. That was illegal. You could go to jail for that. It was called general solicitation. And now it's permitted because of the Jobs Act. But I don't know if there's any real way to avoid getting down into the weeds, because the problems are the weeds. The costs are generated by the weeds that our friends in the Congress have created and that in the regulatory agencies. And I think we're going to have to do a better job of articulating the vision, which is an America where you don't have to be a lawyer to run a business, because I think nowadays you almost have to be. I also think that you mentioned some of your young startups. I think if those people really knew what it meant to run a business today, they'd run for the hills. They're walking into it ignorant. But if they understood that they're really signing up to be a lawyer and an accountant and a compliance officer, and the price of getting it wrong is that you're going to have these massive fines that will crush you for years to come, then they wouldn't do it. And I think more and more people are coming to understand that that's the price of being in business today. And I think policymakers have no clue what they're doing to this country in terms of just the combined weight. Any specific rule sounds reasonable. All right, well, we're just going to ask them to do this, and we're just going to ask them to do that. But when you add up literally the hundreds of those things that even a small business in a simple service business has to deal with, it's crushing. But there is no single solution. I don't know if I answered your question, but it's a serious problem. And you're starting to see it in the aggregates. I mean, and you're starting to see it in terms of new business formations. Brookings did a very good report showing that new business formations now are less than business exits. So far as I know, that's never been the case since the Great Depression. We're really, truly killing the goose that lays the golden egg, and we need to fix it.
Well, from my perspective, it comes down to leadership. And, there is the possibility, but it does take the leadership and the vision and a commitment, to this. And, it takes, someone in the White House that's going to herd cats and have a vision and, really be, whether it's tax reform or regulatory reform or any other issue. And there's a lot of hard decisions, to make. I mean, sometimes the answers to the most complex things are the most simple things, in terms of like a unified rate business, unified rate, for all businesses, for all business income. But, there's winners and losers in that. And we just got to make sure when you do something like that there are more winners than there are losers. And even the losers, there's something in it for them, maybe in terms of less complexity or just certainty. So, I mean, that's just taxes. Dave's right. I mean, there's just tons of these issues. And even the tiny, what he says, even these little things, regulations now that some of those are just so huge, the impact of what they're doing at each of these, whether it's Department of Labor, EPA, et cetera, are suffocating. I think the good news is, again, I always like to share good news. The public, I think, is aware of this in terms of big government, in terms of the need for transparency and reform of the regulatory system. I mean, certainly on taxes. I mean, this has been a winning issue for a long time in terms of fairness, and people think that everyone, the majority, large majority, think if you have one rate, everyone pays fine. That's fair. And there's a lot of great stuff happening at the state level. I mean, we do an index that ranks the state. There's a lot of these indexes around. We've been doing one for 19 years now. And what you see happening at the state level that I think is sort of leading and, creating some traction and momentum, hopefully, at the federal level, on the tax and regulatory front. Hopefully we'll get that to Washington in the next few years. Lower taxes, less regulation, and the actual performances in those states, economic performance in terms of attracting in businesses, attracting investment, sort of higher levels of entrepreneurship and job growth in those states, to actually make these reforms that are more competitive from a tax and regulatory perspective.
And it has been done. If we look at the former Soviet republics, countries such as Estonia, Latvia, Lithuania, they put in place flat tax systems that have been relatively simple. And just one anecdote, I ordered a baby blanket for a friend who'd had a baby. And it was a beautiful hand-crocheted blanket that came from Estonia, mailed from Estonia with a little chocolate bar in wishing me Happy New Year. And entrepreneurship is certainly alive and well there.
Other questions? Yes.
Thanks. My name's David. I work here at the Heritage Foundation. I'm curious, to what degree do you think that this continued hesitation to lower the corporate income tax is in part due to this public misperception that we need to punish the corporate executives and the greedy corporations without understanding that studies have repeatedly shown that the true burden of the corporate income tax is borne by workers?
Right. I think it's not so much a public perception. I think if you tell anybody that our rate is the highest in the industrialized world and it needs to go down, even Republicans agree on this, Democrats in Congress agree. They've all made speeches. Senator Barkas made speeches on it. Even President Obama says we have to lower it. But then, as Karen said, the devil is in the details. So in exchange, President Obama wants to raise other taxes or take away what he calls corporate tax preferences, raise taxes on the oil industry, even though some of their deductions, such as the domestic manufacturing deduction, is just the same as any other manufacturing companies. So the problem is that there's a divergence between Republicans and Democrats as to what to do when you lower the corporate tax rate. And perhaps with the dynamic scoring bill that's gone through the House of Representatives, people are going to take more effect of the macroeconomic consequences and the possible repatriation of earnings that would occur with a change in the corporate tax rate.
Other questions?
Well, just if I could add
ahead.
on that issue of corporations, everyone thinks it's like a big business issue again, but lowering corporate rates, 87% of the corporations in this country have fewer than 20 employees. So there are a lot of small to mid-sized businesses, that are C corps, and again, and people tend to think, well, gee, it's just the large guys that may be doing these inversions or moving overseas. But we have members, who are that are for this company, they decided to domicile in the UK because the lower corporate tax rate, location because of other business interests going there, but the more
it's because of the low tax.
Yes, and the UK is what 20% or something, 20%. But also they're doing a lot of things in terms of startup visas and all this other, all these other policy changes that are encouraging entrepreneurs and businesses to come to their country. And
they have better securities laws too.
You're right, they do.
Yeah, they don't
on
have
the
Dodd-Frank.
Yeah, and you're right for IPOs, for crowdfunding.
The
all
AIM
those
market,
things, yeah.
crowdfunding, all of it. Yeah.
Yes.
They don't have Obamacare. They don't have the National Labor Relations Board. They don't have EPA.
So this gentleman here.
Hi, my name is William Davis, and I'm with Tax Notes. I have a question. You're talking about tax reform. I think everybody can agree tax reform is something we need. Your discussion, with the exception of talking a little bit about employment taxes, it's limited to the income tax system. I know Senator Cardin just last month introduced a consumption tax, income tax bill. Consumption tax is something that has been discussed since the 1970s from both sides of the aisle. I was wondering, we spend a lot of time comparing ourselves to the other OECD countries. They all have a federal VAT. I was wondering if you have any thoughts on bringing in some sort of consumption tax to the United States as a way to lower our rates in a revenue-neutral manner.
So it all depends on the context. So the context you're talking about is adding a VAT on top of the system that we already have. That's completely and totally unacceptable. That would greatly increase the tax burden in the country. So every other country, developed country, does have a VAT, but they also have vastly higher tax burdens. So there's no reason to give Congress a second way to bleed us dry. The only way going to a consumption tax is acceptable is if we eliminate the income tax. There's certainly better taxes than income tax, whether it's a VAT or retail sales tax or some kind of the flat tax or consumer income flat tax, whatever version you go with, better than the current system that we have, the current income tax. But it's too dangerous to add it on top of the current structure we have, and that's what Cardin would do. He wants the VAT to greatly expand the tax burden. That's the purpose. So only if you get rid of the income tax, which means getting rid of this, most likely getting rid of the 16th Amendment, and then go to a consumption tax. That's the only acceptable way. Replacing
the current tax system, corporate and individual income tax, with a consumption tax would be very pro-growth. But the thing I think a lot of people don't grasp is there's basically 5 ways to get to a consumption tax. You can have a European-type credit invoice VAT. You can have a retail sales tax, like the fair tax. You can have a Hall-Rabushka-type flat tax, which is also a consumption tax, a consumed income tax, such as Heritage proposed a few years ago. So there's 5 basic ways to get to a consumption tax. And if you replace the current tax system with a consumption tax, you're likely to see, over a period of a decade, an increase in GDP of something on the order of 15%. So the gains to be had from replacing our current broken tax system with a well-crafted consumption tax are very high.
Yeah, and I just,
No, I was just going to agree. I mean, the replacement as opposed to the add-on makes sense. I mean, particularly when you're talking about a VAT, which really, from a transparency perspective, but from a complexity perspective as well, is just really, really difficult for small to mid-sized, business owners to deal with the complexity of a VAT.
Right, and also what it does is it cuts into states' sales tax revenue, and states rely on that revenue. But really the simplest way of getting to a consumption tax is a consumed income tax. In other words, you're only taxed on the money that you spend. So we broaden the allowances for savings and maybe make them into one group. So rather than having your 529 account for college savings and your 401k account and your IRAs, you just make one large saved income account, and you are just taxed on any money that you don't put on that. So it's basically the equivalent of a consumption tax. And then on top of that, you add expensing for business, and you get to really the same place as you would if you had a value-added tax, but in a lot simpler way.
And it's less dangerous because you can run that through the income tax.
Right.
It looks like an income tax, but it's actually a consumption tax.
Yeah. And in fact, some people say that we, in essence, have a consumption tax now because people haven't exhausted their retirement vehicles. Most people don't put the maximum into their IRAs or their 401ks or their
As long as we
SEPs.
double tax corporate income, we're not close.
Right. Well, we could. One can make adjustments through the income tax. That way.
I understand it. Any other questions? This gentleman.
Thanks. I'm Mike Palitz with Policy and Taxation Group, and we work on a state tax repeal. Mr. Dubai, I think this question is more for you. Would you mind responding to the idea of postponing the estate tax until after the business is sold in favor of raising individual rates? Will that still not be an incentive for the family or the heir to sell the business afterwards? This will be a barrier?
I'd have to think about it more. I haven't thought about that particular aspect. I mean, so anything that prevents the breaking up of a small business at the time of the founder's death is going to be beneficial. The devil's in the details, as always. So you want to make sure that, so we want to get rid of the death tax altogether. That's the ideal situation. We should not have a tax on the transfer of estate. But my only concern would be breaking up the if we're going to have it, why have disparate treatment between all sorts of different types of assets? It gets kind of difficult to administer and to figure out the effects. But yeah, I mean, I'm certainly in favor of anything that makes it less likely that a business will be broken up when the founder passes away.
You should really take a look at the bill, put out by Andy Harris, I think last December. And it is revenue neutral. And it's completely optional, by the way. So someone can opt into it or, you opt into it if you want. So a small business owner, if he thinks he's going to get hit with that, then he can choose, and he pays the higher income tax for at least 7 years. And then his estate does not get broken up until it is sold. It doesn't get broken up at death. The estate tax is only due after the estate is sold. So the nice thing about this is it's an optional suggestion.
All right. We have one question. If we could make it short, to be good.
A Northern Irish solicitor told me that they guesstimate their earnings for the upcoming year and they pay their taxes based upon that. And that's sort of the precedence that we saw with Obamacare, where you would guess what your earnings might be. Is this going to become more of a trend? And Mr. Dubai, I come from the arts world. How do you separate a small business from how you described to the prior question, when your product is artwork, which also has a fine art value to it and has an heirloom value?
It gets incredibly complex. It's very difficult. You have rules written, and there's always exceptions, and then lawyers go back and forth with the IRS, and it's incredibly complex. There's no simple answer to it.
All right. Well, thank you all very much for coming. And the last point is, I believe the next tax event that we're going to do will be on the flat tax, probably sometime in February.